Okay, so the webinar is now live. We're just going to wait about a minute or two for the attendees to start popping in. So just give us a few moments. Okay, the numbers are popping in. Let's give it another 60 seconds before we get started. Okay, so thank you all very much for joining. We're just going to get started now, and then hopefully as we record, everyone will be able to come in later, and we'll send out the recording as soon as possible after today's webinar. We all know that the CARES Act 1, 2, all the PPP loans have been a major question and concern of how to tap into and benefit from these things. As of late, this ERC or ERTC, as people are calling it, has been a question that profits or non-for-profits have been wondering how to and what it means for them and how to tap into it. There's different concerns from 2020, 2021, whether they were closed, whether the loss of revenue. And it was very hard for me. Honestly, we were getting a lot of questions, and I reached out to many different accounting firms to ask them if they would be willing to give a webinar, if they felt that they had studied it up. It took a while, but through the work at Agudah, and I think it was even specifically EDN, someone did reach out to me, and he said that he felt that Withum, Jake he knew at Withum, was had expertise in it. So we reached out, and I appreciate the fact that the team at Withum had spent many hours researching it, understanding how this applies for the for-profit and not-for-profits. And I just want to take a minute to introduce our panelists over here. Many of us know Rabbi Eliyahu Stern. He has, besides being the executive director of probably the largest school in Lakewood, he also is the founder of EDN, an executive directors network, which has, I think, correct me if I'm wrong, probably I think 700 members, a great group of people always sharing information, sharing questions about running schools, running any not-for-profits. And he's been a go-to person. A lot of the questions that have come in have gone to him both in the PPP and also now with ERTC. So he's going to be running and moderating the session. With us, we have over here from Withum we have Daniel Mayo, Daniel has more than 20 years of professional tax experience as well as experience in federal, international, financial products taxation. He's a member of Withum's National Tax Services Group and oversees the U.S. Federal Income Tax Research, Planning, and Reviewing function. He's experienced in mergers and acquisitions, capital markets, and cross-border transactions, which most of those things, I have no idea what those mean, but I'm sure he's good at it. Jake Weichholz is the principal, and he is at the firm located in New York City office. Right now, he's attending from Eretz Israel in Jerusalem. Tells us it's snowing there. And he has 44 years of accounting experience, specializing in working with business owners and management of public and private companies. Jake's area of expertise include entrepreneurial business services, retail and consumer products, wholesale, professional services, law firms, and the non-for-profit sector. And then we have also with us Israel Tannenbaum. Izzy has more than 17 years of experience providing value-add, compliance, and tax consulting services to not-for-profits, clients of all sizes, including public charities, private foundations, membership associations, arts and cultural organizations, and all other subsectors of the non-for-profit industry. He's an expert in unrelated business income, tax, and foreign filing requirements for tax-exempt entities. He has experience in providing employee benefits, tax, compliance, and consulting services to a diverse group of clients, including Fortune 100 companies and some of the largest pension trusts in the world, and assisting clients with the implementation of the requirements of various laws, legislation, and regulations for federal and state levels. hopefully we will have, we'll go through the presentation now. I'm going to give over the mic to Jake in a moment, and people can post questions in the Q&A, post questions on the chat bar. We will try to get to a lot of the common questions. Afterwards, we'll try to see if we can get a write-up of the main points, and even maybe sharing the slides from this presentation. That will go out to all the people who registered for this event. Also, there is a credit for this. Rabbi Stern I will post the link of where people can register for the credit, and Rabbi Stern will give out, during the presentation, we'll give out 2 codes that you will need to get the credit for joining this webinar. Jake, I hand over to you.
Yes, thank you. Thank you. Thank you for that introduction. I thank the Agudah for giving us the opportunity to reach you and be able to provide a service to the community. Withum is a mid-sized accounting firm, on the top 25 in the country. We have about 1,200 professionals in 13 different offices, not counting Israel where I'm sitting. We really divided into industry groups. One of our major industry groups is not-for-profit and education. I see a number of familiar faces and clients that are included in the participants. We're available to help you, whatever your needs are, whether it's tax, accounting, advisory. We appreciate the opportunity. The real expert today, though, is Dan Mayo, and I'm going to turn it over to Dan unless Anishai wants to do that, and he'll get kicked off with about 20 minutes worth of presentation, and then we'll entertain questions.
Okay, let's give it over to now Rabbi Stern. Please, let's get started over here, and we'll have both the two of you and Dan Mayo, share the floor.
Okay, well, thank you very much for all the introductions. Just as by way of introduction to this seminar or webinar, where the goal is really to focus exclusively on the ERTC, Employee Retention Tax Credit or Employee Retention Credit, and the ramifications of what it means, how to apply, how much money is in it or not in it, what are some of the basic guidelines. We're not going to be talking about extended family leave, extended sick leave. We're not going to be talking about PPP. It may come up for part of it, but I see a lot of questions already popping up about PPP. We're going to stay focused on the Employee Retention Tax Credit. Having said that, we're going to start off with just what is the Employee Retention Tax Credit and the difference between what was and what is. And when I say what was, Congress had passed multiple things over here, and the first thing that passed did include the Employee Retention Tax Credit, but most people did not pay any attention to it because PPP was much larger, and you were not allowed to take both. And therefore, a lot of the discussion out there was about the PPP, and it kind of went under the radar. That all changed on December 27th when the new aid was passed. When that passed, then they said you can take it even retroactively for 2020. However, the guidelines for 2020 and 2021 were somewhat different. And I'm going to give the floor over to Dan to kind of give you a basic overview of the Employee Retention Tax Credit for 2020 and the Employee Retention Tax Credit for 2021. Dan, the floor is all yours.
Great, thank you, Rabbi. Pleasure to be here. Thanks for having us. I spend about the bulk of my time these days on the PPP and the ERC. So as Rabbi mentioned, we will discuss the PPP only to the extent it impacts the calculation of the ERC. If there's time, I'm happy to take questions on the PPP too. Again, we've done a couple hundred loan forgiveness applications in the last few months, and so we're very well versed in that. So today I'm going to spend about 20 minutes going through the slide deck, which we can make available after we're done today. And so you'll have that if you want it, and we'll focus on the nonprofit aspects of it. So first I'll give an overview, high-level overview, and then we'll drill down into some more of the details that I think people will care about. So let's start with what is it generally? The Employee Retention Credit is a fully refundable credit. It's a credit for wages paid to employees during periods of economic hardship, which are defined in 2 ways. And this is sort of the main eligibility you need to obtain an employee retention credit. Either have a full or partial shutdown relating to the pandemic, or you had a quarterly drop of 50% in your gross receipts from 2020 versus 2019. And regardless of the reason, the reason you have the drop is not important. It's assumed to be related to the pandemic, but you don't need to prove that it is. It came in originally, as the rabbi mentioned, it came in on March 27th as part of the CARES Act, the Employee Retention Credit. But the dramatic change, which gives rise to this refund opportunity for 2020, is that last year in December, they passed this Consolidated Appropriations Act, which eliminated the ban on the ERT in the Employee Retention Credit if you also retain the PPP loan. And this is, again, very important because it creates a significant refund opportunity. We have some clients getting hundreds of thousands of dollars back for 2020, and also getting hundreds of thousands and even millions in 2021. So it is a tremendous opportunity. So I have a chart here. We'll start with a chart that compares the 2020 versus 21, and then we'll move into the details. So there's the eligibility test, again, full or partial suspension of operations. You see here, this is a link to the IRS FA frequently asked questions. They posted about 80 or 90 frequently asked questions on their website. They're only on the 2020 column, not the 21, because they've not been updated to reflect the new employee retention credit. The IRS has announced that guidance will be coming soon, but when asked how soon, they declined to give a specific time frame. So the FAQs we expect will not change to the extent the law is consistent between the two. But where the program has changed, obviously they'll issue different FAQs. But for the example, this full or partial suspension of operations, there's been no change from the 2020 to the 2021 employee retention credits. We expect that those will remain unchanged other than tweaks to what's been written. You see there's the drop in gross receipts in 2020 was 50% quarter over quarter. So you compare, for example, quarter 2 20 to quarter 2 19. If you had a 50%, more than 50% drop in gross receipts, you'd be eligible for the employee retention credit for that quarter. And then it continues until your gross receipts recover to 80% of the same quarter in 2019. So if you had a 60% drop, right, so your 40% of your 2019 number, you had a 60% drop, you would be eligible for quarter 2. In quarter 3, if you had a 10% drop, you'd still be eligible for quarter 2, but it would stop there. That's the way that 80% rule works. If you recover, so that you divide 2020 by 2019, you get a percentage, and that's what they're basing the 50 and the 80% on. In 21, the credit gets much more generous, as you see. The decline in receipts only has to be 20%. So you're comparing Q1 21 to Q1 19. That is, again, same 2019 reference period. Again, Q2 21 to Q2 19, that's the comparison. There is an election you can use to use the previous quarter. So instead of using Q1 21, for example, you could elect to use Q4 20 and you'd make the comparison to the same quarter in 19. We'll go over this in more detail a little bit later. The wage period is 2020, it's March 13th to the end of the year. And in the 21 credit, again, which is much more generous, as we'll see, it is only the first 2 calendar quarters, so January to the end of June. In terms of qualified wages, it's 10,000 in all of 20 in essence, and in 21 it's 10,000 for each of the first 2 quarters. So this is where there's a significant increase in the credit, because you can get, but we'll see it's 70% credit in the first quarter of 21 with the first 10,000, and 70% of the first 10,000 of wages in Q2. So the credit percentage also changed. And again, I'm just trying to give an overview. Some people, we're trying to level set the knowledge base. For those who already have a familiarity, this will be helpful. If you're new to it, this will be, we'll cover in greater detail the next slides coming up. There's a 50% credit of the first 10,000 of wages in 2020, which gives rise to a maximum credit per employee of $5,000. In 21, that credit gets significantly more generous because it's 70% of wages, but they do it on a quarterly basis. So you can get 7,000 per employee in the first quarter and up to 7,000 in the second quarter, giving rise to 14,000 for the first 2 quarters of 21 versus a maximum of 5 for the whole year of 2020. There is a legislative proposal that's been put out there to extend the employee retention credit to the remainder of 21. So all 4 quarters, but that's not been passed yet. As of now, it's just the first 2 calendar quarters. So with that, I'll skip over some of the things that I think are probably not as relevant. Covered employees is the next key. This is a very key thing. This is what dramatically determines how significant the benefit this will be for your organization. And it's strange that when you measure the FTEs, they use 2019 here, even though you calculate wages based on 2020 or 21. So for the 2020 credit, right, so that left column, top box in the middle, covered employees, if your average number of full-time equivalents, and that's not gross headcount, that's a calculation, which we'll talk about later how it's done. If your average number of FTEs in 2019 was 100 or less, then you can get the employee retention credit on the wages for all of your employees, making it a very significant opportunity, right? If 100 employees, you get $5,000 per employee. That's a refund opportunity of $500,000.
Provided you meet the eligibility, correct?
Correct.
Either shut down or drop in revenue.
50% decline in gross receipts. If you're over 100 employees in 2020, it's a significantly reduced opportunity here because you can only you only get the credit for the wages for employees that you're paying not to work, which we affectionately call the Netflix employees, right? So somebody couldn't come to work and they couldn't telework. That's the key definition. If they can't work from home and you're paying them to do nothing, you can those people you can get the credit for, but not all of your employees. So you see, very few organizations pay their people not to work. Which is why if you're over 100 employees in 2020, it's a significantly reduced credit. There's still an opportunity there, but it's not as significant as if you were 100 or less. In 21, they greatly expanded it. So that average number now of FTEs in 2019, they look at 500 or less. So now if you have 400 employees, for example, the credit can apply to all of your employees' wages, all 400. Very significant difference from the prior year. So they've extended and really expanded the 21 employee retention credit.
Dan, when we're talking about this extension and essentially applying for it, we're talking about schools who, and probably most of our audience are schools who were affected to some degree by telework. So just to kind of clarify that point, to the extent with the schools where they may have pivoted over to some degree to more classrooms or giving their services through telework, that would not fall into this equation, correct?
Well, so if they're under 100 employees in 20, it would count. Those wages would count. But if they're over 100, you're right. That's not considered paying someone not to work because they are able to work if they're able to telework.
But if it took
them, not just telephone, by the way.
If it took them a month or two to get up and running on Zoom or whatever the case may be, that period is shut down. They weren't working.
Correct. If they're not able to telework is an odd name. It includes using the internet. It's just an odd concept. They say telework, but really remote working is what they mean. If you can work remotely, then you are providing services that would not count if you're over 100 employees in 20 or over 500 in 21. On the PPP point.
Okay.
Yes.
Dan, if I can just jump in here for a minute, I know you're planning on drilling into how to calculate that FTE thing. But just to point out here, you're not talking about employees, you're talking about the full-time equivalents of employees, which when you're dealing with schools, which are primarily part-time employees, just because you've got the morning staff, you got afternoon staff. Besides for the administrative office maintenance staff, you're pretty much dealing with a lot of people that are part-time. So that 100 number may sound low initially, but when you start drilling into the full-time equivalent, that will shift it. Yes. I understand you're going to get to this a little bit later in the presentation to understanding how to calculate that. Also, just want to recap just quickly for a second what you said, what Jake pointed out before. Step one is, did you have the mandated shutdown and did you have the 50% loss? That's really step one. You don't even come into this conversation if neither were true. Schools primarily had the mandated shutdown, depending on the state, but primarily schools did have the mandated shutdown. After you've qualified under that, now the question is, the amount of employees is a second criteria you got to cross to understand, because it's dramatically different whether you're above that threshold of FTEs or below it. After that, you can start talking about how much money. So essentially, those are the steps for every organization to kind of figure out. Number one, did you have a mandated shutdown, or for 2020, a 50% reduction, 2021, the 20% reduction in revenue, again, matched to 2019. not the 2020, even if you're in the 2021 year. Number two is assuming that the mandated shutdown, assuming you are eligible with the mandated shutdown, you are eligible with the reduction in gross receipts, then how large are you? Are you above 100 FTEs? Are you below 100 FTEs? Or I should say, were you above 100 FTEs or below 100 FTEs in 2019? Not 2020, not 2021, in 2019. And then again, the other question is, are you above or below the 500? That's the other threshold. Once you've determined that, now you get into, okay, how much money can I claim? And that's where you get into those questions. But don't even approach those questions if you haven't addressed these first. Yeah, I'll let you continue with that, and we're going to get into some of the detailed definitions on this as we go.
Yeah, and we have a flow chart on our website, which Jake can circulate if anyone wants, which walks through exactly what you're saying, Rabbi. The order in which, the critical path in which you have to walk through to conclude whether you're eligible and how much you're eligible for. So let's focus in on the...
Just those that are here for the CPE credits, the first code is AG35. Again, that's AG35. That's the first code. There was a link posted in the chat box on how to apply for that. Again, the first code is AG35. I'm going to let Dan continue.
Thanks. Okay, so the two-part test for 2020, the eligibility we mentioned earlier, was a full or partial suspension or a quarterly drop in gross receipts by more than 50% compared to 2019. So some other things you need to consider: you must carry on a trade or business in 2020. You can't be closed. There's no size limit. This applies to large and small employers, but the credit amount differs, as we talked about, and it includes tax-exempt organizations, which is most relevant to the crowd here today. So let's talk about what a full or partial suspension is. It's a three-part test, and again, when you get the slide deck here, these underlined things, these are links. So you hit control. If it's not working, you can click it. It'll take you right to those FAQs. The government order restricts your operations. The order limits commerce, travel, or group meetings, and it affects the typical operations of your business in a non-trivial manner. There are aggregation rules that apply. You have to, in the PPP, they called it affiliation, and they had their own set of affiliation rules. Here it's different. It's called aggregation, and they refer to some IRS codes, Internal Revenue Code sections to define how what rules you apply to aggregate employers. The only reason I mentioned the PPP here is that if you Google affiliation, it's going to be different. They call it affiliation for the PPP, but it's called aggregation for purposes of the employee retention credit. So common examples, which are listed in these FAQs, to have a reduction in seating capacity, like a restaurant or movie theater, reduction in hours of operation. An order prohibits your suppliers from making delivery of critical goods to an essential business, which would be a school. Or a partial closure of your operations, like a lot of medical practices were not able to perform elective surgeries. That was considered a partial shutdown. Examples that do not meet the test are if your business can run comparably through telework, and this includes internet. It's really remote work, but the word the IRS uses is telework, so we stuck with it. Also, an example where it does not meet the test of a partial shutdown is where your business is able to operate, but the sales were down, right? So you have less students coming, perhaps. Because of COVID-19. So if you're able to operate, but you have fewer students or students drop, so that would not count. But you may still qualify under the 50% of gross receipts test. So we have it's either or, it's one or the other. You only need to qualify under one to get in. So let's talk about.
Dan, if I can just jump in here for schools specifically with this teleworking, if you can just weigh in on that. Essentially, most schools, I would say probably 99%, if not 100, the whole concept of teleschooling never existed. It was a complete new phenomena. We had schools we had many parent bodies that don't have internet. Some went to Zoom, some did it by phone. Everyone had their own way of doing it. They were severely compromised. Needless to say, anybody with any kind of special education was completely decimated from this thing. So if you could just weigh in on that with the partial shutdown, because I know a lot of people have that question, will they kind of shift it over to schooling over the phone or over Zoom?
Yeah, so I mean, there was a shutdown, right? Because they limited the number of people that could congregate in rooms. So there was a partial shutdown of your business. I mean, so you would qualify under that test. It was mitigated somewhat through the ability to have remote schooling. But that still would qualify as a partial shutdown of the business because of the government order restricted the ability to have in-class schooling. But if you were able to operate your business, once you were operational though through the remote schooling, that would not be considered the period of a partial shutdown. So there is a time period where it took time to ramp up.
But Dan, even when they were operational again, instead of having 7 hours of classes, maybe they only had 5 hours of classes, but yet the teachers were paid as if they were teaching 7 hours of classes, I presume. Is that partial shutdown?
Yes, well, there's a couple things here. The shutdown just relates to the reduction in your business, not the point you're getting at is also about whether you paid people not to work, right? You paid your teachers if they're paid an hourly wage, they're not working a full day. But the point is, if you have students, right, you have some students who backed out, that's more akin to sales were down because you lost your business or customers. And so that wouldn't qualify.
I know,
but they still pay tuition. They're still paying full tuition though.
Yeah, if they paid the tuition.
Well, it's more than that. The classes were severely compromised. I mean, when you got to control a class on Zoom or on the phone, the classes were definitely severely compromised even once they were up and running. The reason many of them couldn't do the full day simply because it wasn't feasible, not because people didn't want to, just it simply wasn't feasible. When you're dealing with a classroom, you got the educational portion of it, you've got the behavioral portion of it, you've got the, kind of the whole playground politics, if you will, element of education, you've got the, the spirit of the classroom, all that was lacking. So the question really is, would it qualify as partial, considering some of the examples the IRS gives in that question 33, where there's definitely, there was definitely a forced reduction over here, even when they got back up and running with the Zoom.
Right, and so you mentioned, correctly, question 33 talks about a governmental order requires an employer to close its workplace, but the employer is able to continue operations comparable to its operations prior to the closure, right? And so that's going to be the question: is how comparable are you able to operate the business today or back in 2020 versus prior to the pandemic? And that's just going to be a factual question that's going to be specific to each school, right? There's going to be different answers for different people. But to the extent you were impacted, yes, that would be considered a partial shutdown.
Got it. Okay.
Okay, so cool. Moving on just a little bit here to qualified wages. Again, we talked about in 2020, it's March 30th, the end of the year. It includes 10,000.
I think you Dan, I think you skipped the screen there with your test number 2.
Gross receipts. Sorry, I apologize. The quarterly drop in gross receipts is 50% versus the same quarter. It can be any quarter in 2020. There's a couple rules you need to coordinate here, though. It's only March 13th to the end of the year. Then it's the quarter in which you have the drop in gross receipts. So what are gross receipts? I know this is an important question. Right here, you see this is the definition for for-profit entities, and this is what's listed in the IRS FAQs, and that's not what's relevant for tax exempts. I understand that. What's relevant for tax exempts, unfortunately, they did not provide guidance. In the PPP area, they did provide guidance for tax exempts. And they referred to this regulation 6033-1A2 to the lie. So I think a tax exempt, you can probably use that as a guidepost on what it means, gross receipts mean in the context of your business. And in that regulation, it is a very broad definition. It does include the gross amount of grants and contributions. It includes the gross amount of dues and assessments that are received. It includes the gross amount received from unrelated business activities. And it includes gross receipts from sales of assets and other investment income. So it is a top line revenue number. It includes almost everything. It's hard to figure out what it wouldn't include, but it's meant to be a top line number. But as long as you're comparing apples to apples, that's the key there too, is your 2020 versus 2019. Let me stop there. Any questions on that, or Izzy, you want to jump in?
Yeah, I would just add to that, Dan, from the pre-PP side, like you mentioned, they did kind of clarify that. And what they've said, at least in terms of that, was they really are trying to get that at that gross receipts number. So if you think about it from a 990 filing perspective, they essentially say take line 12, which is your net income essentially, and add back all the expense items. So cost of goods sold, your cost basis in any maybe securities or things like that that you've sold. So they really are trying, it seems like they're trying to get to an actual gross number without any investment expenses or anything whatsoever netting to that number, even though on the actual Form 990, some of these numbers are reported at their net value. So it's just important to remember that you can't just pull that line 12 number from your Form 990 and report that. You have to actually add back certain expenses that were netted out in that process. And again, that's on the PPP side. So it's not definitive in terms of the ERC, but probably a good indication of what the IRS is thinking when they say gross receipts.
Yeah, I mean, the SBA and the IRS are both arms of the same government, obviously. But unfortunately, it's not definitive, to, or dispositive to say the SBA said it in that context, therefore it must apply here. That doesn't work that way with the IRS. So, but there's no reason they wouldn't follow this definition. So it seems like the best approach to take, and the only real approach we can suggest, right? That's what the Internal Revenue Code says in a different context. The aggregation rules are going to apply, and these are very complex, so we're not going to get into them now. But they're very, you need to aggregate. The easy cases where you have 100% owned subsidiary, right? And that's clearly going to be aggregated. You need to look at when you look at the number of employees, you have to aggregate and look at how many employees are in both entities, for example, in the case of a parent sub. When you look at the declining gross receipts, you need to combine or aggregate both entities to look at the gross receipts of both entities in order to make the 50% determination. So that's going to be important, is that you consider those aggregation rules. Okay, so moving on to qualified wages. Dan,
can I trouble you to can I just jump in one thing about accrual versus cash basis on that gross receipt decline? If you can talk to that for a minute. As far as the measuring of that by the quarter, which kind of gets a little dicey. You're not filing much for the actual quarter. That would indicate, for example, you get a practical example that I think played out by a lot of people is from March 15th, let's say, through April 1st, they may have received checks. They were everyone was shut down. Everyone's trying to figure out how to work remotely. Those checks were only deposited April 15th, April 10th. Which quarter they go under? That's a question that I know a lot of places have been trying to grapple with, as far as if they're in the first quarter or the second quarter. Can you talk to that for a minute?
In that case, so the method you keep your books on. So that's a unique situation where you're getting checks, and unfortunately, if you're a cash basis taxpayer, right? The question is whether you're cash or accrual. If you're cash, you receive the check, you have to include it the period you received it, even if you held on to it for a couple of weeks and didn't book it. It's the period you receive it. If you're accrual, it's whenever you earn the revenue. So it really depends on how you keep your books. If you're using this tax definition, I mean, how you keep it for tax purposes would seem to be the best way to keep track of the gross receipts.
The way you file your 990, I presume, on a cash versus accrual.
Right.
Right. Just one more thing that
we're not pointing to anything specific that says that, but if you're going to use this definition, which I think makes the most sense, it would make sense to follow the method used for tax purposes as well.
Okay, and then the PPP funds do not count for this. Just to clarify that.
Correct.
All right.
Okay, so then we get into qualified wages. Really here, I know I want to somewhat limit this, but we will make the whole deck available. I want to focus here on these last points here. If you're relying on the full or partial suspension test, qualified wages include only the wages that are paid during the period of the suspension. You don't get the whole quarter, which makes the declining gross receipts test a little more favorable because it applies during all the relevant quarters. So if you had a 60% decline in gross receipts, you get that in quarter two, for example, you get quarter two and you automatically get quarter three. You'll also get quarter four depending on what happened in Q3 or Q4. But when you qualify for one quarter, you automatically get the excuse me, the next quarter. So that will be, 6 months worth of wages can be included right off the bat. So it's going to be more beneficial to rely on the gross receipts test if you meet it, but it is an either or test. You don't have to.
Right. So just if I can, right, if I can just clarify that the way, just to make sure I understand it correctly, when you're dealing with the mandated shutdown, which is the full or partial suspension, then it's specifically for those dates that you were shut down.
Correct.
When you're dealing with
if it was a 3-week period, it only applies for those 3 weeks.
Right, and again, that presumably that's going to be true for 2021. If anyone were to get shut down in 2021, it's the exact dates that you're shut down for.
Correct.
However, when you're dealing with matching your receipts and you have that decline in gross receipts, then it's by quarter, and that whole quarter counts. Not only that quarter, the next quarter will count as well until you cross that 80% threshold. And
in 2020,
if you did,
that's going to change in 21.
That's only in
each quarter independently.
Oh, okay. All right. So then in 2020, if you pass the decline in gross receipts, then you're eligible for that quarter, the following quarter as well, till the end of the quarter where you cross that 80%.
Correct.
So that means I have 50% reduction in quarter 2. Quarter 3, I had a 75% reduction. I'm still eligible in quarter 3. And then quarter 4, I hit that 82%, let's say. So now I'm eligible through the end of quarter 4, but I will max out at that 50% of 10,000 in terms of the dollar amounts.
Correct.
But my eligibility for quarter. In 2021, you're saying that it's not, that it's each quarter individually. You have a first quarter and a second quarter. If you're eligible for first quarter, you stick with first quarter. If you're eligible for second quarter, you stick with second quarter. The eligibility does not carry through to the next quarter.
Correct, because they don't have that return to 80% rule in 21. It's just, so it's more generous in that it's the 20% decline test, more than 20%, but you don't automatically get the next quarter.
Okay, and then just to weigh in on 1099s, I'm not sure if you're about to get to that or if that was in the first part of the last screen. Those that you pay 1099, any kind of outside contractor, I know.
Any independent contractor, if you're not paying Social Security, if you're not paying FICA taxes because they're, for example, a church employee or they're an independent contractor, their wages do not qualify for purposes of the employee retention credit.
Okay, so simple test is, are you paying FICA or you're not?
Right.
Yeah.
This is FICA, the Social Security and Medicare, the FICA taxes. On the qualified wages, it does include group health care, health plan expenses. I won't focus too much on this, but they are includable. The key here is different from the PPP. The PPP was only the employer paid portion. Here it includes the amount paid by the employer and the amount paid by employees with pre-tax dollars. It doesn't include employees after tax dollars. So you can't just rely on your PPP numbers. You do a little more digging.
So if you furloughed employees and stopped paying their wages, but were still paying their health insurance costs, that would qualify.
Correct. You can include the healthcare costs even though you didn't pay them cash wages. You can't double dip with the PPP. You can't double dip with these provisions listed here. The PPP, the FECRA qualified sick and family leave, the work opportunity tax credit, the PATH Act, R&D research and development payroll credits, and paid family medical leave under Section 45S. So it really does lead to a tremendous mapping exercise. When you map the wages, you map your eligible wages for the eligible employees for the year, and then you need to back out any wages that were reimbursed under these other provisions. And so we'll talk about on coming slides ways to do that that's most favorable, but that's the exercise that you can't double dip. In terms of limitation, we talked about this, more than 100 or less in FTEs in 2019. That's the key test for the 2020 retention credits. Again, it's going to be 500 employees for the 2021 ERC. But so this is the test. Let's talk about how to calculate. That's what everyone wants to know, right? And so the way you calculate your average number of FTEs in 2019 is based on the Section 4980H, and I've summarized the rules down below. So you take the sum. It's monthly averages for the entire year of 2019. So you add up, for example, your number of FTEs each month, and then you divide by 12, right? You take the monthly average and divide by 12. FTEs, this is also different from the PPP. So it's a different FTE test, it's a shame that there's so many different tests out there. They should have just stuck with one. But there was a 40-hour test for the PPP. Here, FTE is anyone who works at least 30 hours a week or the equivalent on a month, which is what they view as 130 hours a month. If someone's part-time, and this is what you mentioned earlier, Rabbi, you can have 200 part-timers, but still have under 100 FTEs. Depends how much they work. And this is a strange calculation. What you do for each month, what you do is you aggregate the number of hours of all your part-timers and you divide by 120. So I put together a simple example here. You have 4 part-timers in that month. They each work 40 hours in that particular month. So you're going to multiply 4 times 40, right? The total hours for all the part-timers, 160 divided by 120, and you're going to get 1.3 FTEs. So 4 part-timers in this case translated into 1.3 FTEs.
Right. Okay. So now just to weigh in on this, because this I know has a lot of ramifications, specifically for schools, but I think in a lot of businesses, depending on the nature of their employees. For example, you have a substitute. Substitute comes in for 3 days, a total of 9 hours. So essentially what you're saying is you take the month, take all the hours of anybody that is under the 130 hours a month, 30 hours a week, 130 hours a month, and then add that all up together and then divide that number by 120, and that's your number. So you're going to include all those substitutes, and you're going to include anybody from any kind of a teacher that comes in only for 3 hours a day. So essentially it gets very tedious to add this up. Basically, for example, if you have 250 employees on your payroll, you may very well only have 75 full-time employees by the time you're finished with this. But in order to figure it out, you have to take every single person's hours, add them up, and then I know you're going to get all kinds of questions. Well, does prep time count? Does this count in terms of the hours? I'm assuming the time they walk into work to the time they leave to work, not the driving time, not the time before that.
I view it as paid hours.
Paid hours. When they're paid salary, how do you do that?
Well, so let me just go. If you're paid to drive in, they're working 3 hours, but they're paid to drive to an hour each way, you count 5 in that case. If they're salaried and they're part-time, I just look at the number of hours they worked.
Got it. Okay.
So this is the calculation. It's a unique calculation to the ERC. You're going to add the part-timers and the full-timers and come up with your number. Again, just to highlight, just because you have a large number of part-time employees doesn't mean you're not going to get under 100. I did this calculation recently for a gym. They're a company that has a big studio in Manhattan, and they have like 90 personal trainers that are part-timers, and they have 60 full-time employees, and they got under the 100 count. So don't be scared by the large number of part-timers.
Yeah. Okay. One good question pointed out over here is Passover break. A lot of people paid through Passover break, and they kind of split it up in 2 different ways. One is the salaried employee is just paid on the annual basis. But the hourly, what some places do is they pay for the amount of hours that the employee would have worked. It's kind of a benefit they give to their employees where they pay them through Passover break as well, even though they're actually not working. So are you saying that you would assume whatever you're paying for, meaning if you're basing that off of a 7-hour day, then that's the way you're going to look at it. If you're basing it off a 3-hour day and that's the way you came up with how to pay them over Passover, then you would count those hours as well. Is that accurate?
I think so. So that's a pretty specific question. I would need to look at this 4980H, but that seems like a reasonable approach. But again, this is a detailed calculation. We just would need to look into that to give you a definitive answer, but that sounds like a reasonable approach.
Got it. Okay.
All right. So the 2020, it's 50% of wages up to the 10,000, so 5,000 max credit we talked about. Can't double dip. We talked about that as well. How do you claim it? I know this is a question we got from a lot of people who submitted them prior to the webinar. You reduce your employment tax and your income tax deposits by the amount of the anticipated credits when you won't suffer any penalties. When you look at the IRS FAQs, they're very misleading because they talk only about your employment tax deposits. But when you look at this notice 2020-22, it makes it clear you can offset your income and employment tax deposits. This will be relevant for 21 ERC, not for 2020, so it's just a refund opportunity. So the way you claim it is on the 941. You would, in 2021, you'll reduce the with your deposits by the amount of your anticipated credit. And if the amount of your credit exceeds your deposits, you can file that form 7200 and get an advance payment from the IRS. So for 2020, though, how do you claim it for 2020? This is going to be retroactive on this 941X, and that's the amended return for the 941. So the way that works is you file quarterly 941s. So you file Q1, Q2, Q3, Q4. If you use a PEO or payroll provider, they would do that for you. So when we do this calculation for clients, we in essence give them 4 numbers. It all comes down to 4 numbers, and that's the number of credits they're entitled to for each of the 4 quarters, and then they amend the relevant quarter. So if you're entitled to a 10,000 credit in Q2, you amend Q2. If you're entitled to a 50,000 credit Q2 and Q3, you would amend both of those quarters. And so that's the way it works. It's a very simple process to amend that form. You see, it's just this one line on the form gets changed. But if you have a PEO, they will do that for you, or a payroll provider. Whoever your files your 941, they're going to be the one to amend it.
Yes, and then, we had an interesting experience with our payroll provider where they said the IRS is going to release guidance on how to file this without having to amend 941s. So they didn't want to do it for us yet. They want us to hold off. Would you agree with that statement?
I don't know what process they're contemplating without filing an amended return. You're going to have to file something. So we don't know the procedure. They're right. We know a 941X will work. When they come out with guidance, and it literally could be any day now that they're going to come out with these new guidance on the employee retention credit. But they may come out with some simplified procedure. It may just be they have a fax number. You can fax these to the IRS to speed it up. I don't know. That they've used that in other contexts, the fax number. I don't know how they're going to do it here, so it's just speculation. It's anyone's guess what they're actually going to do. But the way to amend, until they say otherwise, the way to amend today is the 941X.
Got it. Okay.
And as to whether you should wait, I was on the phone with a client this morning, and they said, I'm busy with other stuff. Can I put this off for 2-3 months? And the answer is yes. But I said, but you really need to assess the magnitude of how much money you're getting back, because this really is a free cash opportunity. It's free money they're giving to you. If it's a large number, you want to do it sooner rather than later. The other thing to consider is if you're going to file a extension, you want to know the amount you're going to pay, because it'll determine your tax liability. So you want to get it in you want to hopefully have it calculated by the time you do your extension, certainly by the time you do your final return, so you don't have to go amend the return later on to account for these credits. Okay, the suggested approach here. So what we're suggesting people do, if you've already submitted your, let's talk about the PPP for a moment. If you have not submitted your PPP application.
Dan, if you just give a quick introduction to this, basically because you can't double dip. That's so now you applied for a PPP round 1, first draw, you got the PPP. Now you did apply for forgiveness, you didn't apply for forgiveness, to discuss in a moment, but the discussion here is, if I'm using this payroll, and when I say this payroll, I don't necessarily mean the full payroll, I mean this person's specific payroll for that PPP, I cannot go and claim the ERC on that. So the question is, how do you get through that murky or confusing waters? So if you can suggest how to approach that.
So let's say let's say this is a Q2 issue for someone, right? They have a period of shutdown that covers the second quarter, so April, May, and June, but they got their PPP May 1st, their loan May 1st. So the way you would do it in that case is the first month's wages are eligible for the ERC, but the second 2 months would be eligible for the PPP. And so that we would have to map out the wages to determine what's ERC eligible and what's PPP eligible. Now the PPP was a loan based on 10.5 weeks approximately, right? 2.5 months. It's about 10 weeks. And so you don't need the full 10 weeks to get forgiveness because you're allowed to use up to 40% for non-payroll costs. So you really only need about 7 weeks minimum, right? To get the PPP forgiveness. So there's no guidance yet from the IRS, but they did issue something. It was a press release or something where they said any wages eligible for either program can be used. So they suggest you can take any flexible approach that makes sense. And so what we do is, what we've been doing is we'll take the wages that were used on the PPP. So if it's $1 million PPP loan, most people have a large cushion. They put 2 million of wages on the PPP application, right? And a non-payroll cost. But we look at the wages for a moment. We would determine the minimum amount of wages you'd need for the PPP amount of forgiveness you requested. And then we allocate them based on the highest paid employees first, on the theory that they're going to have excess wages, right? You're capped at 100,000 for the PPP. So let's say someone was paid 150. If you took the first 46, 154, that's 24 weeks of wages for the PPP, you can use that excess 50,000 for the employee retention credit. So the goal here is you want to allocate as many wages of the higher paid employees to the PPP, so you can allocate the lower paid wages to the ERC and hope to get everyone to that $10,000 limit. And so that's the approach we've been taking to maximize the ERC wages. So solely for purposes of the ERC calculation, we allocate the PPP wages among the highest paid employees first, and then work our way down until we get the requested amount of forgiveness. And that way the lower paid wages are available for the ERC. Does that make sense?
So, I mean, isn't it a wash?
No, it shouldn't be. It's definitely not.
Well, lowest paid, you mean under the 100,000. That's what you mean?
Well, you can have, if your highest paid is 90, your lowest paid is 30. We want to preserve the wages of the 30 so they hit the 10,000 sooner.
Oh, I'm sorry. Okay, fine. The 10,000, got it. Okay, I apologize.
Yeah,
right. Now, the lowest
cap.
paid, since you're maxing out at 10,000, yes. Okay, I apologize about that. Okay, since you're maxing out at the 10,000, so now the lowest paid wages are the ones that you want to really use, focus. If somebody's, for example, getting a salary of $100,000, so now his quarterly wage is just simplified. Let's call it 25,000 per quarter. He's going to max out very quickly. When somebody's getting paid 40,000 on the year, so then they're getting paid 10,000 per quarter, it's going to take them longer to max out. So you want to use the lowest wages for that employee retention, and then because it's a per employee thing, and PPP just focuses on one aggregate, one big number of how much did you spend.
Right.
So now this.
Ahead,
you keep a spreadsheet for this? Is that what?
Yes.
Is that the idea, that you would have a spreadsheet and that's your backup, in case anybody asks?
So we've spent like tens of hours building a model and trying to break it, and working it and studying it, and we have multiple people working on it, again with the goal of trying to come up with problems. And so we think we've got it down to a science now, where we map the wages in the most advantageous way for people, so that all of the PPP, the minimum amount of the PPP is allocated out first, and then everything else is used for the ERC, but we do it in a way that maximizes the ERC. And so that's essentially a mapping exercise. And we're creative in the way we map it with the goal of maximizing the ERC.
Got it. So that's a spreadsheet that you built, I'm assuming, for your clients.
Correct. Well, we don't provide the spreadsheet because we want to reserve the right to update it over time. But we do the calculation. We produce in essence, we produce a one-page output. We'll always have it, the calculation, but we produce a one-page output, which will show your wages, the wages necessary for the PPP, excess wages, and then the wages allocated to the ERC and by quarter. And then we break it down by quarter so that we know the aggregate amount of ERC each quarter, so we can amend the 941s. The appropriate
And we
941s.
Right. Okay.
And yes, we do use it with our client, but our client could be someone who just engages us to help them secure an ERC.
Okay, that was my question. If people on the call want to follow up with you, essentially they can engage you for figuring this out for them.
Absolutely.
And basically they give you the numbers, you give it back to them, etc. Just the second code for that CPE is AG45. That is the second code, again, AG45. First code was AG35, second code AG45. Yeah.
I'm a lawyer, and when we do this, the CLE credits, they usually blink it on the screen in big letters, and it's AG45. So to your point, that anyone can hire us, engage us just to do their this ERC credit. I just want to caution people, We've heard that there are companies out there approaching people and they're charging a percentage of the credits, a contingent fee on the percentage of the credits. We think that's grossly unreasonable. So if someone's getting a $200,000 credit, they get a $30,000 fee, 15%. If they're getting $1 million credit, they get a $150,000 fee. We think that's grossly unreasonable. We charge based on time, the amount of time it's spent doing the work. And so I just caution people, whether you use us or somebody else, you don't need to pay a percentage of the credits.
But I encourage you, there's a lot of money potentially involved here, so don't be hesitant to get a professional to help you with it so you can maximize the amount of money you can get back. It's a small cost to pay, I believe.
Right. Yeah, there's each business and organization is going to have its own little detailed question that can have a ramification of thousands of dollars, literally. As in, how do you count the hours that are being paid? How do you count reduction? How do you count wages? Who's included? For what are they included? And much more than that. So definitely encouraged to engage a professional on your final calculations before you actually go to submit it. Yeah, I'll let you continue, Dan.
Yeah, so I'll go quickly. There's rules on M&A when you acquire businesses. Not so relevant here. The taxation of the ERC, this is important. It is taxable income. The effect of it is taxable. So it's not includable in income, but there is expense disallowance. You lose deductions like with the PPP before they passed this recent rule. So it will be taxable for business entities. Let's talk about the 2021 ERC quickly. Eligibility, remember this is 20% drop in gross receipts test. I'm just going to point through new stuff here. They expanded the reach so it includes public universities, hospitals, medical care, also employers not in existence in 2019. The qualified wages, first 2 calendar quarters of 21, as we talked about, it's up to $10,000 per quarter. Same rule if you have a partial suspension for 3 weeks, it only includes wages during that 3-week period. But if you get to quarter 1, you get if you have the 20% decline in gross receipts, you get the entire quarter. You don't automatically get Q2, as we talked about. Each quarter must be tested independently. The 100 rule is now 500. So if you're at 500 or less FTEs in 2019, I keep stressing that, right? If you're 500 or fewer in 2019, you can include the wages of all your employees in 21, even if you have 510, right? So it's a strange outcome where if you have, you're testing on 19, but you're including the wages of all employees in 2021. 70% of the first 10,000 in Q1, 70% of the first 10,000 in Q2. You cannot average the quarters. So if you have 11,000 of wages for one employee in Q1, you'll get 70% of 10,000. If you have 9,000 in Q2, you will get 70% of 9,000, right? Which is 6,300. So you won't be able to average out the wages of Q1 and Q2 like you could in 2020. It's a per quarter determination. Same rules, prohibitions against double dipping as with the 2020 credit.
Yeah, if I can just, I see a question here that a bunch of people put up there. If they applied for forgiveness on the PPP and just gave everything to the SBA, you know, it's a 24-week period, they just gave it all to the SBA. Does that preclude anything on the ERC? Again, using this backup spreadsheet, yours or somebody else's, that they keep on file showing this was used for PPP and this was for the ERC? Absolutely
not. So if most people, let's say you got $1 million loan, the example I like to give, if most people will have $1.5 million, 2 million, or even 2.5 million of eligible costs on that application. All those wages that are on there, let's say it's a 2 million of wages on a $1 million loan, you're not excluded from using some of those wages. You're only excluded from using $1 million of wages because that's what gave rise to forgiveness. You're not punished because you put an excess amount of wages on the PPP loan forgiveness application. The question is, it becomes an exercise in creativity in figuring out how much of the PPP and which employees were necessary to get that full forgiveness, and then we can allocate the rest to the employee retention credit, and so we can maximize the opportunity there. What I tell people too is if you haven't filed your PPP application yet, there's no need to hold it up for the calculation of the employee retention credit. What you want to do though is you want to maximize your non-payroll costs, which was not the case 6 months ago before they extended their employee retention credit and made it available. People were just putting payroll on and not bothering with the smaller utilities, et cetera. Now the goal is to maximize the non-payroll costs, so your rent, your interest on mortgages, utilities, covered covered supplier costs, covered worker protection costs, the expanded list of non-payroll costs. You want to maximize them, and you want to maximize the retirement contributions and state and local employment taxes. So on the PPP application, maximize non-payroll, retirement benefits, and state and local employment taxes. And the reason is those are not eligible for the ERC. So if you can maximize them, you put less wages on your forgiveness application. Therefore, you have more wages available for the ERC. So that's how it works in terms of what to do if you haven't filed your PPP loan forgiveness application yet. So that's different, again, from what was done 6 months ago. 6 months ago, people said, I know I could get my rent payments. It's not worth it, though. I have so much payroll. It's not necessary. Now it is necessary. So we encourage people to collect your water bills, utility bills, your rent, and put as much of that on the application as possible. The 2021 credit, you don't have to amend your return. You can just reduce your employment deposit. So this is a great way for companies, businesses, and school. If you have employment tax deposits of 20,000, say, but you're expecting a credit in the first quarter of 21,000, you would pay nothing that quarter and file for an advance payment of that extra 1,000. If you owe 20,000 in employment tax deposits, but your anticipated credit's only 10,000, you would reduce it by 10,000, only pay 10,000 that month with your 941, and you keep the 10,000, other 10 for yourself. So it's a self-withholding mechanism. You get the money a lot sooner than having to go through a refund opportunity with the IRS. So that's the way it'll work for Q1 21 and Q1 22. When you get the slide, we have a sample request list document we request. We shorten this quite a bit for a lot of entities. This is very comprehensive. I just put it in here so everyone saw the universe. So that's sort of where we are. I guess I'll open it up to questions at this point. I know we're almost near the end of the hour here.
Yeah, essentially, I mean, one question that has popped up is as far as if somebody already applied for forgiveness and they kind of used just salary, they didn't put in any other expenses. My assumption is it's a little too late at that point for them to go back and somehow amend that.
Right, so there's no formal process by which you can amend your PPP application. I mean, you can try, it's up to each individual lender, but you could amend, but we're finding, at least in, we've done probably 8 or 9 calculations so far, the employee retention credit. We expect to do hundreds like we did for the PPP loan forgiveness application. We've already started the process for many clients. We're finding that it's not a hurdle. We can still, with our approach, our flexible approach, we can still maximize the employee retention credit to a great extent. Would it be a little better if they had maximized their non-payroll costs? Yes, but it's not proving to be a significant hurdle at this point.
Okay, and then another common question is regarding definition of income, which you highlighted earlier. My understanding is that pretty much it's pretty broad. In other words, I know in the schools that are dealing with lunch programs and things like that, these are things that are typically reported on the 990s. I'm assuming that all that would qualify, and there's really very little to really exclude over here. Is that accurate?
Yeah, I think that's right. From a 990 perspective, that seems to be the case. Although to Dan's point earlier, obviously they haven't given the definitive guidance or definition at this point. But again, just kind of paralleling to what's been put out there for the PPP, I would say that's probably the way that the guidance will ultimately shake out. But just to add to that point, remember, it's not net of any of the expenses associated with the program or anything like that. So it's really just going to be the actual gross income amounts from these. Right.
And one more piece to clarify here also, because I know I see a lot of questions coming up on this. The whole ERTC, again, Dan said this clearly before, is it's a payroll tax credit. So if you're not paying payroll tax credits on it, then it doesn't walk in the door over here. So any kind of benefit and things like that, again, it's payroll tax credit if it's included in your regular payroll tax system. I know parsonage is a question that's come up a bunch of times. Parsonage is not included. It's not something that you pay taxes on. There's a lot of discussion about if the parson gets wages and those wages The IRS doesn't require the employer to be taking the payroll taxes from the FICA from either. So if you're not taking the FICA from that, you definitely don't qualify under that. Even for those the wage portion, the QTR benefit, which is given by a lot of schools, is not some. It's a benefit. It's not something that would show up anywhere on the wages. And again, it would not be subject to this credit either. Essentially, the simple test is take a look. Are you paying payroll taxes on it? If you're not, there's nothing to talk about. If you are, then you can have a conversation about meeting all the guidelines. It's not possible to get to all the questions. I think there's literally over 500. Kind of try to take the most common ones as we went through over here, and I kind of give it back to Shai, I guess, in terms of where it goes from here. But Dan, thank you so much. This was great. Izzy, thank you very much. Jake,
Pleasure. Thank
thank you very much. Very, 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 very helpful. We really, really appreciate it. Extremely informative and thorough.
And Rabbi Stern, I want to thank you very much for moderating, also and all that you've put in, for the many months till now, both on the PPP, answering people's questions on the ERC. Thank the team at Withum for, the work they put in before, taking the time out of their day today to share this information. The plan is that I will be sending out hopefully a recording, also the slide from Dan, and also the content information to be able to, consult with them if needed on their specific model, the way they do things. This was very informative. Obviously, there will be, I think, updates coming on through the SBA and the IRS and if need be, we will have to do an update or another webinar at a later time. And we're going to try our hardest to maybe put together something with the questions. So many questions came in. A lot of them were touched on during this, during the webinar itself. We'll see if we can get out on our own personal FAQs to send that also. Jake, any last minute?
And we will also follow up if we have your email with some of the flow charts and some of the references that Dan was referring to, and again, make ourselves available. Someone asked about our fees. It's generally a fixed fee to help you through the process. Depending on your circumstances, we'll tell you what it is up front, and we'll work with you.
Okay, thank you all very, very much. Thank you for your time, and looking forward. Thanks a lot.
you.
Okay, thank you.
Everybody be well and stay healthy.